Good morning, ladies and gentlemen. My name is Eric Schatzker. I'm with Bloomberg Television. Welcome to Follow the Flow, How Asset Management is Reshaping the Global Financial System. Good to see you all here today. I'm sure you're having a great Milken Global Conference thus far, and we're about to make it better for you. I'm going to introduce our panelists to start off with. To my far right here is Kent Clark. He's the Managing Director at Goldman Sachs. He's the Chief Investment Officer of the Ames Hedge Fund Strategies. Right beside me here is Jeff Gundlach. He's the CEO and Chief Investment Officer at DoubleLine Capital. To my left is David Harding. He's the CEO of Winton. Beside him, John Chervum. He's the Chief Investment Officer at Oregon State Treasury. And finally, on the far left here, to my left that is, to your right, Jess Staley. He's the Managing Partner at Blue Mountain Capital Management. Just a couple of very small housekeeping items before we begin. This is standard practice, of course. I don't have, unlike a movie theater, a little video to show you, but please turn off your cell phone ringers or at least put them on vibrate. And if you need to have a conversation with anybody, do us the courtesy and everybody else the courtesy of taking it outside. And there will be no Q&A given the size of the audience here and the difficulty of managing questions with this many people. We're not going to do a Q&A at the end. Without further ado, I think it's time to begin. Most of you, all of you, I should hope, have by now noticed that there's a little bit of concentration happening in the asset management industry. And I want to share with you a couple of tidbits just to get the conversation going that I have gleaned from conversations here at the Milken Global Conference over the past couple of days. One was with a senior executive at a traditional asset manager who told me on Sunday night that he worries that his firm, which has $175 billion in assets, isn't relevant anymore. And the second was a conversation I had yesterday with someone who runs an alternative asset manager and is considering an IPO. He said that one of the reasons to go public is the need to get to $100 billion in assets as fast as possible. What are these people talking about? Let's start with that question, really. How big does an asset manager need to be today to quote-unquote matter? And I will turn to Jess to give us a sense of what matter means.
Well, I think the most important thing to matter is not size, is investment performance. So we shouldn't lose sight of that. There are tremendous small managers that deliver great investment performance, and they matter. But there is this reality that I think if you go back 15 years ago and if you're a traditional long-only manager, if you had over $1 trillion, the general impression was you were too big. If you were a private equity firm and you were over $10 billion, the general view was that you had outgrown your asset class. And if you were a hedge fund and you were over $1 billion, it was time to move your money elsewhere. And I think what has happened is, to a certain extent, because of the growth and concentration of long-term savers, whether it's pension funds, sovereign wealth funds, very large family offices, having an investment manager that has sufficient scale to take the size of check that you want to write, but not get overwhelmed by allocating to too many managers, has led to a benefit or an institutionalization, particularly on the alternative side. So take a large pension fund that has some tens of billions of dollars, makes a decision today to allocate to the hedge fund community $5 billion or $10 billion in capital, does not want to be overly dispersed in terms of its allocation, picks 15 to 20 managers, and all of a sudden you see the size of the check that has to be written to make that concentrated investment. And if you don't want to tilt the ship too much of the firm receiving that money, you're talking about allocating to people with clearly north of $5 billion in assets. So that dynamic, I think, has led to a concentration. And then I think that the performance of a number of firms has shown that there is not a direct correlation between scale and underperformance. And some of the larger firms have done extraordinarily well and have used their scale to be able to turn the investment tables in their direction.
John, you're in the business of making decisions about whom to allocate capital to. Do you find yourself feeling the irresistible tug of scale? In other words, the kind of dealing with the phenomenon that Jess, well, it's not a phenomenon, the sort of the circumstances that Jess is describing, that it's no longer, it doesn't make sense any longer to deal with dozens or hundreds of discrete money managers. Far better to maybe sacrifice something, but gain something in return by turning to a platform, if you will, where you've got multiple strategies under one roof.
So the short answer is sure, that temptation is strong, but it's strong for practical reasons. Namely, we have 13 investment professionals managing $90 billion. So just the ratio of staff per AUM forces us to be, number one, extremely judicious in the relationships that we pursue. But over time, since we have not grown our staff commensurate with our AUM growth, we have to write bigger checks. And yet it's a challenge because in Oregon we have a terrific tradition, particularly in private markets, of being first-time investors. And so we want to honor that part of our tradition and certainly continue that legacy. So I don't have a single bullet yes or no answer. It's just a constant struggle. And then we have policy considerations too. In private markets, our board doesn't want to look at anything under $100 million, and we can't be more than 25% of any one fund, so that defines the lower bound. And then on the upper bound, we want to be important. We want to be on the LPACs. We want to be in the inner circle of the LP group. So again, no single answer, but just a constant struggle between the practicality and the performance issues and the legacy issues.
Yeah, I think the firm answer that I come up with on this is it depends, right? And it depends on what your resources are critically, right? It depends on your what your appetite is for delegating some of the work, right? So if you're willing to delegate, if you have 13 investment professionals and $90 billion under management, that clearly sets bounds on what you can do. But one of the things that we've seen increasingly is that investors are still interested in smaller managers or managers that are early in their life. By the way, we don't sort of fantasize that is universally better, but there is a certain kind of advantage to be attained there. And so for investors who have this challenge of large assets, relatively small staffs, there's always the alternative of having somebody help out, right? Particularly because when you're investing with smaller managers, you want to diversify that single manager risk. So there's certainly the pull to large, and sometimes you'll read every couple of years somebody will write an article saying that larger managers do worse than smaller managers. The nature of the data actually that they use really lends you more to the conclusion that the managers that were fortunate enough to get big did really well when they were small, right? Because there's a huge amount of survivor bias. So the conclusion is usually wrong, which is that the manager that gets to be large happened to that was the group of managers that survived and did well when they were small. And most managers that get large and continue change the nature of what they do, and they use size to their advantage.
I think by definition, managers that are large are basically doing something that's, they morph into something that's more of a beta than actually a niche strategy. And I think our world clearly has, thanks to a bull market for the past 6 years, and you might say longer than that, stocks and bonds, active management, particularly in equities, has been kind of uninteresting because an index fund kind of gets it done. And yet around the edges, with disintermediation of the banking industry, many of the better opportunities in the investment management industry are rather small scaled. At least that's what we think at DoubleLine. We see a lot of sort of direct lending sort of opportunities and other things of disintermediating banks, and we don't think you can really do a lot of scale in those types of products. So it's not surprising to me that the institutions have gravitated to kind of large managers for beta and smaller managers for creativity and some of these lesser scaled opportunities.
You've built, in how many years now? 3, 4 years?
5 years.
5 years. $75 billion business.
Yeah.
How big do you want to be?
Not more than double where we are today. I mean, I guess I'm fighting against the tide here. Everybody wants to be huge. We want to have happy investors and feel that we're doing a value-added sort of creative enterprise. And so we think about closing some of our successful strategies rather than trying to make them 10 times bigger. So I don't know. I guess I'm too old. Having started this firm when I was in my 50s, I'm too old to try to raise $1 trillion and go around the world saying I'm sorry. because the performance, as you pointed out, the performance has been great, but if you turn into $1 trillion, it'll be the survivor bias concept. I'm living off of the past successes, and I just don't think you can manage that kind of money and have differentiated risk-adjusted returns. Maybe other people can, maybe it's just a deficiency on our part, and we can't, but I really feel that excess AUM bloat is something that probably, as the CEO of DoubleLine, I want to avoid.
David, you've got north of $30 billion in assets at Winton. Is size an advantage to you or a barrier to you?
I guess your question addresses the legitimate tension that institutional investors observe in money management firms between the asset gathering and the portfolio management function, and
yes, that kind of nails it on the head.
exactly. And but my defense would be kind of that if you're good at money management and you have experience, in other words, you're in the business for a while, then you're going to become successful, and that means you end up becoming bigger with time. So I think having experience is good, and being good at your job is good. So being good at your job and experience is good. So being big is good. There's a lot of, I think, statistical selection bias surrounding the analysis of the performance of size of managers and so on. So because there are millions of small managers, there are obviously millions of always good performing small managers, and to compare a manager as the manager's salesman will do and say, we are small, we are better, ergo the smallness equals the betterness, is the most egregious form of statistical error. It's a very simple statistical mistake. But, I completely accept that there's a tension between, asset gathering firms and investment management driven firms. And every firm has to make its own decision about how to navigate between those two poles.
Well, how do you balance then what you just described, sort of being in the middle of this tug of war between the need to build a business and the need to continue
we get much more
returns?
we get much more user-friendly to our customers when we're doing badly, and much more tough when we're doing well. So the key is to invest when we're doing very badly, but of course most people don't want to. So
Jess, how does Blue Mountain manage that tension?
I think size is obviously relative. If you're 30, 70 seems high. If you're 70, 150 seems high. But there are advantages to scale, particularly in markets like credit. If you can take control of a certain bond issuance, you have a certain ability to manage the investment profile of the security that you're investing in. Clearly in the private equity world, being able to take control of a company, or the distressed world, being able to take control of a distressed situation because you have size. So if you have the investment talent, scale is not necessarily a detriment to performance. In fact, it can be a benefit to performance. The issue I think that all of us would agree on is Blue Mountain and other firms, we cannot gather assets beyond our capability to invest them as well as we possibly can. So do we have the investment expertise? Do we have the track record? Do we have the history? Do we have the risk systems? Do we have the process institutionalized enough so that we can take the assets that are coming our way and generate the returns that our clients are looking for? So I don't think it's an either-or decision. It's just how do you manage your firm? And if, like Jeff was saying, if you get to a size that you're comfortable at and you're delivering good investment performance, you want to stop there, stop.
I really agree with that. I mean, it's sort of like you've got to understand what your identity is as a firm, what you want to be. I mean, I kind of view that there's different stages of the asset management business. It starts out with two guys in a Bloomberg managing their parents' money, and they don't need much. And then to get to a couple $1 billion, you really need a compliance officer. You need a certain amount of infrastructure. And then you get to another phase where you're at like $20 or $30 billion, and now you need about 100 people. And then the real question becomes, do I really want to go to that next level? And at DoubleLine, my answer is no. And the next level is global footprint, offices all over the world, 2,000 people. You're kind of like an army. You're going to lose people every year just through attrition. That's just the way it goes because you have so many people. And we hired somebody from one of these mega firms to run our operational group. And he'd been working at DoubleLine for a couple of weeks, and I come up to him and I said, "Hey, Patrick, how's it going?" He says, "I just love it here." And I said, "Why?" He said, "I was so tired of waking up and jumping for the phone to see if something blew up in Singapore, because it's not as manageable when you have that sort of global footprint." So the question is, what do you really want to be, and then put together your resources so that you can accomplish that and be happy with your identity.
John, we've heard a couple of investors talk about the limits of scale. Is there a point at which you, the investor, draws a limit on scale? You look at a firm and say that firm is simply too large for it to deliver the kind of performance that I expect?
The answer is going to sound too much like a cliche, but when you get the feeling culturally, you get the signals that the emphasis moves from performance to asset gathering, and there's no, it's not like somebody shoots up a flare, but as you're sitting in the conference room as an asset owner, you get a vibe, and if you start to get the vibe that the original mandate, albeit successful, and the repeat is starting to go off the reservation, and all of a sudden you're sitting in that conference room seeing all sorts of different new products, then it's an indication that the emphasis has really shifted, the priorities have shifted.
But to what degree does scale create a need for itself? In other words, and you talked moments ago about wanting to be in the inner circle of LPs, wanting to make sure that you don't get passed up. We'll just flip it on its head for a moment and look at Blackstone. Blackstone was the only call that Jimmy Lee at JP Morgan Chase made when he wanted to sell $26 billion of GE real estate assets. So if you're anybody else who isn't Blackstone, how do you not want to be that large?
That's right. That's a trade-off. I mean, that type of access is very valuable. So again, we have a mix of managers. We have the mega managers down to the people that we help put in business, and that's, I think, on the asset owner side, the art of running our portfolio is keeping that mix, because you can't just come in at and say we're going to draw a bright line and everybody over X is, quote, now an asset gatherer and we're not going to return their call. At the end of the day, you really have to manage those relationships and eyeball to eyeball get comfortable that there's value in it, be it access, be it economies of scale, being it platform, or being it a specialty that fund after fund continues to deliver.
There's also the reality, which we all see post-2008, that the regulators are going to squeeze risk and leverage significantly off of bank balance sheets. And to the extent that you need credit and financing to fund a global economy, someone is going to step into that space. And the someone that's going to step into the space are those that are involved in managing pensions and sovereign wealth funds and family office, et cetera.
Because that's where the capital is.
Yeah, the capital markets will step into the place of the banks to a significant degree. So to the extent that we have a growing economy, the role of the people up on this panel in terms of doing the capital allocation to have the most efficient economic growth that we can is inexorably going to march forward. And so one way or another, we are going to get more significant.
Well, we're talking a lot about kind of institutional ideas, of institutional asset flows, but one of the causes of great asset concentration also is the fund industry and the ETF industry, where there's a lot of demographic, call it retail money, retirement money, that is involved necessarily in the financial markets. And I think one of the things that will cause further concentration will be the emergence of these so-called robo-advisors, which, I mean, the financial planner industry has a very wide range of quality in terms of the deliverable. I mean, a lot of financial planners are true asset gatherers and do nothing except basically use a template, and others are extremely creative. But the ones that are simply asset gatherers they charge a lot of money. I mean, their fees are rather high for RAs. And robo-advisors' primary offering, I think, is the costs are low.
Describe a robo-advisor.
Well, it's basically just a template, really. You come up with a so-called risk profile, which everybody says that they want growth with safety. So everyone has the same risk profile. And what's your age and what's your goal and this sort of thing. And I think ultimately what robo-advisor does is it's a one-size-fits-all kind of solution. You put it in, if you put the same inputs in for two people, you're likely going to get the same output. And so, but it goes to the draw is the lack of overall success by human advisors at 3 or 4 times the cost of what one can get through call it, an algorithm, or to be pejorative, a spreadsheet advisor. And so I think one of the risks of that becomes that when one-size-fits-all solutions start to be kind of automatically injected into the system, it means that everybody's invested the same way. And everybody will start to move, and I think you start to get systemic risk as that concentration of assets proliferates.
The term robo-advisor suggests to me, I've been hearing a lot out here and a bit in the UK, it suggests some sort of algorithmically driven investment strategy. I
Sounds
saw Andrew
very
Lowe,
fancy and
Andrew
very
Lowe said the other day that in the
but
future,
I'm sure it's just 60-40.
Andrew Lowe said, the top behavioral economist, said that in the future, in 2039, most people will have algorithmically driven financial advisors. And I thought to myself that, it's impressive to be 50 years out of date. The fact that Andrew Lowe is 50 years behind when we started AHL. 50 years we started robo-advisors, 30 years ago. And very, 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 very successful. But inventing it now seems like a rather remarkable, terminological, in a sense, the systemic trading industry of robo-advisors, aren't they? So I don't know how come they're inventing it in 2015.
The point you're trying to make is that robo-advisors are...
Existed for 40 years.
For 40 years, they're here.
And been very successful, generally.
You've been a robo-advisor for a long time, is what you're
saying. 30 years.
Well, you're a robo-manager or a robo-investment person. I think it's different than allocating assets, stocks, bonds, real estate, and so on.
It's a good question, right? Because so what we saw post-crisis, I don't really have a dog in the hunt here, but what you saw is a lot of people kind of reacting to what performance had been, getting out of equities somewhere around March of 2009, right? I know nobody in this room did, and then waiting until we got the daily drip feed of we've hit another record high in equity markets to get back in. So there's an argument for sort of the person who spends their day doing something different than what we all do, having a bit of advice that says hold on, or maybe even rebalance into the thing that has just dropped in value. It's kind of a value strategy to some extent, right? So it may be there's a large number of people who are being increasingly, this is a different theme, but increasingly set out on their own for defined contribution pensions away from defined benefit. And for that group of people, where you say they're sort of under or maybe not as fully advised as they could be, it could be better than nothing.
You raise a good point, though, this idea that people think of herd behavior mostly when it comes to a stampede for the exits.
Right.
But I wonder, to what degree is this, the asset concentration and potentially homogenization that we've observed and we know is happening, a function of herd behavior, a function of the fact that we are in a bull market for risk assets, like the conditions for which we've never seen before.
Right. Well, largely, right? But I think that, so if we look back and, there's, David would know the long history of data on this, but it's hard to imagine a period where there wasn't herd behavior, right? So if we kind of take that as just being kind of the reality of the world, I guess the question is for all of us is how you take advantage of it to some extent, or how you can take advantage of people's natural tendency, investors' natural tendency to herd. So I would assume that, I think, Jeff was saying about, people who kind of continue to pile on to, more equities as equities go up, and there's this pro-cyclical kind of nature. The question is, I think it's really hard to time when that all breaks, but the question is how you can take advantage of that natural herding tendency.
Here's the question. I think a more important question than some of the ones that we batted around thus far, which is, what are the consequences of asset concentration in the hands of very few mega managers? It could be in the traditional sense, the sort of the long-only mutual fund shop, where we're talking about a number of firms, the largest firms, of course, with trillions of dollars in assets under management, or it could be on the alternative asset platform side, where there are the Blackstones and the Carlyles and the KKRs and the TPGs, et cetera, where it's sort of we're talking about a neighborhood of $100 billion and higher, or in the hedge fund industry where, it sort of seems like $10 billion is, where you need to be if you want to be a player. Let's start with fund performance. I know you think about this a lot, Jeff. At what point does size begin to constrain performance? It depends on the asset class, of course.
It
but
matters a lot on the style of the manager. Those that are heavily allocating betas, I think, can manage a lot of money. Those who are looking for security selection benefits or for kind of niche opportunities, obviously, definitionally, you can't manage a lot of money. So it really comes to that. Obviously, the index fund managers, which ultimately the really big managers have a large index fund business, whether they admit it or not. And there the performance doesn't matter. So it's really, I think you can have successful, very large firms performance-wise if they have either a mechanistic approach using highly liquid markets or they have a heavy asset allocation driver of their performance.
David?
Well, it's variously reckoned, isn't it, that the asset management industry will be 100 trillion by 2020.
May already be.
The estimates seem, the numbers get thrown around, and maybe 400 trillion by 2050 with the increasing longevity, the increasing wealth of the population. Everyone's living forever, they need huge retirement pots. You've got inflation, you've got wealth increasing all over the world. And so there's just inexorable forces behind the massive, massive growth of the asset management industry. And that is approximately as concentrated as the banking industry, isn't it? So the top, the banking industry, I think the top 20 banks have 25% of the global
top
assets.
10.
It's exactly the same in asset management. That's why people are looking at asset management and saying, is it systemically important? It's obviously not the case that you regulate the asset management industry through leverage, obviously, because the balance sheets of the asset managers don't have leverage at all. So that clearly can't be the right answer. I think the answer is
But that's increasingly not true. I mean, I mentioned alternative asset platforms, alternative asset managers.
Blackstone has 4.2 trillion and 9 billion of assets on its balance sheet. 9 billion for 4.2 trillion. Citibank or JP Morgan has trillions of assets, but it has trillions of leverage. So they're just not leveraged companies. What they need to regulate in the asset management companies is liquidity of the funds. Liquidity of the funds. And the money market fund debacle here demonstrated that most clearly, because the vulnerability is to actually panic on behalf of the general public, the media, contagious panics in the markets. A big contributor, I think, to 2008. I think that was the case. And if you have increasing liquidity in products where you shouldn't have liquidity, then you definitely will have deleterious effects from localized and short-term panics. So that's where they should focus their regulatory firepower.
I think there's a current event which is interesting to contemplate as you couch this issue of the growth of the capital markets, which is the decision by General Electric, to divest of GE Capital. So here we have a SIFI, a systemically important financial institution that the regulators have deemed to be of such size and such important that they can cause a systemic crisis in the financial markets, and so have called them a SIFI. Then General Electric takes the decision that to be a SIFI is not where they want to be, and so they make the decision to sell billions and billions of dollars of their portfolios. So the largest middle market lender in the country, one of the largest equipment financiers, one of the largest real estate holders, is now selling this billions and billions of dollars of pooled assets into the capital markets, which is not deemed to be a SIFI. And so we are taking a lot of financial assets out of an institution which the regulators think is systemically important and potentially could create a systemic risk, and putting it into the Blackstones of the world, which are not deemed to be SIFIs. And the question is, will the capital markets grow to such a point in size that the regulatory concern needs to move from what we historically thought was a SIFI to some other sort of systemic challenge given the size and dominance of the capital markets? That's going to be a huge question in the next decade.
What's the answer?
Well, but Blackstone and their peers are funding those transactions in private vehicles that guys like me are signing up for over 10 years. So theoretically, that's a better match.
Right, asset liability match. Right. So is there something, I mean, you make a very good point that if the cost of funding for these vehicles is higher than it was for the banking industry or for GE, the ultimate cost of capital is going to be higher if you're the borrower.
There's no question that the century-old economic engine of giving liquidity to depositors and taking those deposits and making 7-year loans to investors is a funding mismatch or a maturity mismatch that broader society no longer wants to support. In part, what is happening, as John has talked to, is those long-term investments now are being funded by long-term savers. So you have a match of the liability and the asset. One of the questions is there a cost? Have we raised the cost of capital by taking out the maturity transformation? What is the economic burden that puts on the system? But I do think there are a lot of things around transparency and around complexity, embedded leverage and whatnot, that we need to be honest and look very hard at, because I don't think you can have a financial market the size of the capital markets and say because it's match funded, there's no systemic risk.
Yeah, it's sort of a saying that one of the people I work with has, which is, you don't have to worry about bad ideas in our business, right? Because bad ideas die. What you need to worry about is the good ideas that get taken too far. And so I guess just the question is, is there, what is the taking too far of these kind of matched asset liability structures, right? So at what point does that become, too far from the point of view of the sustainability or the availability of credit, the cost of credit? Because it's hard to see at this size, but it doesn't mean that it couldn't be hard to see if that market doubled or trebled in size.
This is, what you're talking about is something new, right? For the most part, the firms that were, that are in question here, again, it's sort of the private equity industry, broadly speaking. Historically, MAD took companies private, fixed them, traded them, either sold them to somebody else or brought them public again. Or it's the hedge fund industry, which for the most part invested in public securities. Now we're talking about a different business, effectively direct lending. And is it necessary? I don't know. Is it necessarily it seems to me like a positive thing. What's the downside? I mean, I guess size, right? If an Ares, right, or a Canyon or a whomever ends up doing hundreds of billions of dollars of direct lending, maybe that raises some big question marks, but they're a long way from getting to that size. Go down that road with me for a moment, John.
Well, we're doing some direct lending. Again, we think it's a logical match in terms of us providing the long-term capital. We're relying heavily, obviously, on our GPs to do the underwriting. But it seems like a sensible approach.
Seems like a sensible approach today, because you, just like everybody else, right, you have a bogey you need to hit. You're reaching for yield. Yeah. Will it be a sensible approach? Will this business exist in 10 years after, the next inevitable major correction in risk assets, and everybody feels a little more comfortable staying, closer to home and, 10-year treasuries or investment-grade corporate debt than they do, way out on the risk curve right now?
Well, hopefully we'll get some warning signs, spread compression, the usual.
I guess it sort of depends what treasuries yield 10 years from now when that happens. One of the unavoidable drivers of a lot of these activities being attractive to institutional asset pools is that they're unable to obtain their investment objectives using traditional means. I mean, I don't see anything particularly systemically risky about someone doing a bunch of direct lending. I think systemic risk always comes from basically the same things. Leverage getting high to the point where somebody ends up going bankrupt because their asset value drops, or else somebody using some sort of insurance policy concept to offset their risk, be it portfolio insurance way back when in 1987, which clearly had a huge negative movement on the stock market. Certainly it accelerated and exacerbated the stock market's move. Or else the biggie, which was the potential total implosion of the financial system through somebody writing insurance premiums with no reserves against it in a shadow financing type of system. So it's
AIG,
leverage.
in other words.
AIG, it's leverage and people thinking that they have something that's going to offset their risk, and then when they need it, it isn't there. Those are what the systemic risks are really all about. It's like earthquake insurance with a monoline insurance company that only does earthquake insurance. It's great, you think you're in good shape, and then it turns out that they're not there to pay. That's what I think is what systemic risk is really all about in the financial systems. If somebody manages $2 trillion of long-only money, and they actually just have net long exposure, what's the big deal if they have a lousy performance? I mean, so what? So their investors sell, whatever. It doesn't matter whether they're selling out of 20 firms or one firm that's 20 times the size of those 20 firms.
A good example is the internet bubble popping and the equity markets being down more or less 50%. Didn't have a systemic effect, right? It was a bunch of people lost money on not a good thing, lost money on tech funds, on tech stocks, but it didn't have anything.
People need to lose money. I mean, that's what markets are about. If it's just about making money, then what's the point?
So why then, David, let's go back to the point that you made about the regulation of the liquidity of investment instruments. If Jeff's right that at some point people have got to lose money just like they make money, why regulate the liquidity?
Well, I don't think it's necessary. Maybe
I mean, that this is an active discussion in America right now, and the money management industry is terrified of the notion that they would have to keep some kind of cash reserve, in the event, to guard against the event of some kind of market dislocation.
I guess I'm just saying that's where the focus should be on asset managers, is regulation of liquidity. I'm not saying it should be stringent. I'm just saying that's where the focus should be. It's certainly not as Jeff says. Leverage produces systemic risk, and it was the banking system that was originating all the leverage that caused 2008. It wasn't the asset management industry. You do get pockets of leverage in the asset management industry, and I guess, when anything does well, then people sell it leveraged up. And I suppose, as an industry, we do have some responsibility, particularly bearing in mind recent events, to weigh in on the side of protecting, the innocent, as it were, against being sold leveraged products to some extent. I think I do feel that there is a legitimate role for, the SEC and CFTC and others to offer some protection against the sale of leveraged products, because people do buy recent returns. People do buy recent returns, and that is the basic sales pitch of the fund management industry, is selling recent returns, and so. But I don't think the industry is systemically, should be designated systemically important in the same way that the banks should be designated. They don't need to be punished, the asset management industry, I don't think.
Well, I think there's examples where there is a systemic risk in large asset managers, and that's ones that are using nothing but a huge portfolio of derivative exposures. I mean, in September of 2008, there were plenty of funds that if the government didn't show up and bail out AIG, those funds might have been worth zero, because the derivatives had absolutely no liquidity. I mean, we're talking about...
Because it was all counterparty risk?
Yeah, it's all counterparty. We're talking about a world where Wachovia one-week commercial paper was bid at 30 cents, right? What do you think the insurance policy from AIG was bid at? It rhymes with hero. So that's where the risk, and that can happen. But again, if it's long only, then your assets might be down, but you actually own them. And so, okay, you lost a little money temporarily, but you don't have this sort of, all of the capital that I thought was there has been extinguished.
And leverage can hide in various, this industry is prone to build towers of abstraction, so that the conversation about what's going on becomes more and more technical and abstract. And then, somewhere down the bottom of the pyramid, there's some leverage,
One point that was raised in a paper that I think we all read, that perhaps you ought to check out, it's by Andrew Haldane, he's the chief economist at the Bank of England, is a potential risk emerging in the asset management industry because of size, and it's a twofold risk. On the one hand, he observed what he calls the de-equitization of the market. In other words, as large firms move into asset classes that are principally credit-driven, there is less, assets as a percentage of total AUM are increasingly fixed income and less equity. And secondly, and this is perhaps sort of the riskier side of it, those firms then, the good ones, tend to be very risk averse in times of market stress. And while they have the capital that they could allocate to support prices, they don't. And it actually works in the reverse. It's the weaker players who step in and provide capital, but not enough, because they're trying to supercharge the returns at a time when they see opportunity. And the and again, this sort of speaks a little bit just to the point that you were making about the withdrawal of banks from providing capital. You were making the point about lending, but it equally applies to market making.
You know, another, I think if you step back and try to see what may happen in the future by looking what happened in the past. If you go back, 30, 40 years ago, and some of us started into the markets, credit was delivered by banks. There was no secondary market. There was no transparency to value. And a bank held on to those assets until they matured. And it was a fairly simple process. Goldman Sachs and Morgan Stanley and others started to develop a capital markets where corporations would disintermediate banks by issuing credit directly. And that market has grown over the last couple of decades. It is very idiosyncratic. Firms like JP Morgan have over 1,500 bonds outstanding at any point in time. Major US corporations are issuing in different currencies and different rates, with different durations and different call features and different covenant features. It's all very idiosyncratic and very difficult to determine value. The market's reaction to try to provide liquidity and transparency to the credit markets, similar to what you have in the equity markets, was the synthetic credit market, was credit derivatives. So if you wanted to talk about, Wachovia credit, you'd say, what's their 5-year CDS trading at? One of, I think, the casualties potentially, and granted they did a lot of destruction, so there is some destruction to that mass destruction. One of the potential things that we are losing as a response to what happened in 2008 is if we lose the synthetic credit market, which is much more liquid and was much more transparent than the cash market, that may expose to this large asset management industry, which has built now a dramatic, it's doubled its participation in the U.S. credit market since the crisis. Is there sufficient transparency and efficiency in pricing and liquidity to support such a large credit market?
No. I don't think there is.
Yep.
I mean, one thing that's sort of shocking is how big the market is relative to the global economy, how many derivatives there are relative to the value of everything on Earth. I mean, I struggle with this all the time. It's sort of like, how can there be hundreds of trillions of dollars of savings in a world that doesn't have hundreds of trillions of dollars economically? And it's through some sort of synthetic world. And if you took the synthetic world away, it would be very, very different. And yeah, you'd have to go back to your 40 year ago type of world, which
I'm a bit skeptical
maybe that's not the worst thing.
I'm a bit skeptical about some of these claims for trillions and trillions, huge numbers. They're often produced to shock, aren't they?
Yeah.
I have an interesting example with in short-term interest rate futures. So when they started all that regulation in 2008, I thought they're bound to get the contract size wrong. They're bound to say it's $1 million contract size instead of being you're trading the interest on interest on $1 million for 3 months. So it's 1,000 times error factor. So I went to see, Michel Barnier and, the Fed and the SEC. I went to see everybody, and that was only the tiny little detailed prosaic points that I focused on. Anyway, 7 years of regulation and millions of hours later, they've got the contract size wrong. So they're exaggerating the size of interest rate futures contracts by 1,000 times. And that will now be going into all the international literature. The people at the G20 will all be talking about it as though it's a very important factor in the world. And it's a trivial error that, the contract size of a Eurodollar futures contract isn't $1 million. It's the interest on $1 million for 3 months. So I do wonder about these sorts of statistics. I wonder whether anyone knows how to calculate what these statistics are. I mean, it may be something worth worrying about. That's what I feel it may be worth worrying about. I don't think we necessarily know whether it's worth worrying.
Okay. I guess on the point of de-equitization, and I think there's another characteristic, a couple of things. One is that there's another characteristic of credit markets that Jeff and Jess maybe you comment on, but that is some of the change of the participation of some of the large liquidity providers, former liquidity providers. I don't know if you think that sort of changes in regulation or post-crisis have changed the participation of some of the players in the market.
Well, there's no doubt that the balance sheets of broker-dealers are much less than they were 10 years ago, and thanks to regulation, will probably never get there again. People talk about this a lot, about the liquidity of the bond market and what it means with less broker-dealer type of balance sheet. I kind of think there's a good news, bad news aspect to it. I think the bad news is that in the old days, when the market had a little bit of noise in it, we'll call it garden variety volatility, the broker-dealers would generally buy things that customers needed to sell, and that would cushion the downside during garden variety volatility. And that's gone. So some activities are not possible anymore. There used to be a very robust activity in the bond market called an 05 swap. You know, you buy bond A, you sell bond B, buy bond A, then you flip back the other way. And all you're doing is really arbitraging various balance sheets from broker-dealers. But the bid-ask doesn't support that anymore. The bid-ask spread is wider because of this lack of balance sheet. But the good news is that I think one of the drivers of the huge decline in 2008 into early 2009 was the fact that these broker-dealer balance sheets had ballooned to be so large, and as the markets were falling, they served as a shock absorber a little bit. But then all of a sudden, the markets dropped enough that the desks at the broker-dealers got tapped on the shoulder saying, we can't take this loss that's developing any longer. We've got to liquidate this portfolio. It's basically fired retro rockets on the downside acceleration of prices. Not only is it retail investors and institutions panicking with their long-only money, it's the balance sheet suddenly joining in the parade of liquidation. I guess if the balance sheets aren't allowed to balloon or chosen not to balloon that way, at least those retro rockets don't fire next time the market goes down. So I think the real biggie of the credit market decline of 08 into 09 probably won't happen again in our investment lifetimes because that condition has been taken away. So under garden variety market conditions, I think it's a moderate negative, but for the big one, I think we're in a little bit better shape.
It's not all bad. We run a $15 billion cash program. I mean, we're the money market for the state of Oregon. We run some longer duration mandates for various state agencies. And, you know, the absence of robust liquidity just makes us, it's enforced discipline. We have to plan better, you know? We have to be really conscious of payroll and debt service payments and all those liabilities, and we have to plan better.
What have you done as a result from an investment standpoint? If you believe that liquidity doesn't exist in the bond market, how have you changed what you own?
Well, I think, the perverse side of it is that it's created opportunities for us and that we're not regulated like a 2A7 fund. So while many of those funds have to go to 60-day or 90-day weighted average maturities, we don't have that. You know, we don't have that pressure, and so that creates opportunities for us. So we can still hang out a little bit longer duration. We can, you know, we don't make any compromises on credit quality, but you know, it does open up an opportunity for a state fund that doesn't have the same types of regulations. But you do have to plan better. You can't show up a day before payroll or debt service payment and, you know, count on selling even something that's, you know, AAA and, you know, in the old days was money good under just about any condition. So you know, we have to be much more, and we can't participate in repo. So, you know, you don't want to be caught short because then you're competing with everybody and their dog for bills and discount notes, and you know, that's a basis point or less game.
Jess, you had a front row seat to what Jeff was describing during the financial crisis.
Let me just say to a point that, you know, if I think I believe this, if all of the credit markets or all the capital, the credit in the capital markets was funded by pensions that have an average liability duration of 28 years, we're probably not going to get into a liquidity crisis. But the truth is, roughly 80% of the doubling in credit from 2008 to now has been funded by money managers that have daily liquidity claims. So I don't think we have matched the liquidity or duration terms quite as perfectly as we have in the state of Oregon. And therein, I think, lies some other issues that need to be considered. And going back and tying that back into what happened in 07 and 08, you know, one of the epicenters of the financial crisis were the money market funds. And in fact, the retail investor did not run. And most institutional investors were reasonably calm as well. it was all of a sudden this vacuum created of what is the value of what I hold. That really spooked the portfolio managers of money market funds as their institutional clients were calling them up and saying, do you have SIFIs? Do you have European Bank CP? Do you have US Investment Bank CP? What's it worth? What's the real mark? And it was the uncertainty of what I own that terrified the market. And I just wouldn't wipe away that we may not, I think there's a chance that we face a similar risk to that down the road. So I don't think we've taken, by any measure, the systemic risk out of the credit markets by moving to the capital markets.
Jess, didn't the retail investors not run because they were all guaranteed by the Fed?
No, one,
why
they clearly were not. They clearly were not.
I seem to remember them all being guaranteed.
They were not guaranteed.
There was a run taking place.
They were not guaranteed by the Fed in the money fund industry until basically the money market funds started to not roll some pretty large U.S. corporations CP. And then they came in and they supported the CP market with all sorts of backstop facilities, which calmed everybody down. But I don't think the retail investor sat there and said, oh, the Fed's going to stand behind it, because there really wasn't clarity that they were going to. The truth is the retail investor acts much slowly. And just like, it's very rare to have a deposit run, the retail investor is fairly slow. It's the institutional market and the smart portfolio managers that want to get in front of the curve, which act with a lot more abruptness than the retail investor.
I'm much less worried about the liquidity in the bond market than other people are. I mean, this comes up on every panel the whole time, liquidity in the bond market, liquidity in the bond market. I'm probably wrong, I'm fairly ignorant, but you just wonder whether it isn't lobbying by the financial system that wants to be able to have Volcker reinstated so they can carry, huge books. I mean, there is a systemic attempt by the regulators to weaken the banks, who are the culprits of the financial system. And a very interesting thing, I think, that affects my industry that I think the audience might be interested in is that in Basel, they are screwing down the cost of capital on the banks so that more and more activities are becoming effectively unprofitable. And prime broking to hedge funds is center stage in that, isn't it? Ken, you would know about that. I mean, the behavior of the prime brokers is being transformed bit by bit by bit. And I think that's going to have a major impact on the hedge fund industry, actually. And that's not the same thing as this Volcker ban, which makes, means there's less inventory being carried by the banks to fund their fixed interest businesses, which were the mighty engines of their profitability, weren't they? But prime brokerage is another of the mighty engines. Fixed interest is number one, and prime brokerage is number two in the mighty engines of the profitability of the banks,
Yeah, well, I don't know that so I'm in the asset management side, not the prime broker side, and so there's a certain amount of firewalls between us, I'd have to say. But what's interesting is, the concern is about leverage, and leverage is, one of the places that hedge funds find leverage is from their prime broker. But what I'd say, at least from kind of a read across prime brokers that we know managers work with, is there's not a lot of leverage in the system right now. That doesn't mean that there aren't some managers who have leverage or who are, have embedded gearing through the use of futures or some sort of off-balance sheet kind of financing. But right now, in spite of the fact that we've had a tremendous amount of herding into, let's say, into equities and some of this pro-cyclical kind of movement, doesn't seem like the vast majority of hedge funds anyway are super levered or in a way that would be sort of risky if they got the call and somebody said, we're going to take off. You can't borrow from us anymore, because it might be not even one turn of leverage on what they're doing. It might be 20% of the 120% long and 20% short or something like that.
Is there enough? Sorry.
If there's a singly important lesson from the financial crisis as we think about the growth of the asset management industry and how it's going to transform the capital markets, I would couch it this way. There were two assumptions that the financial markets took a decade ago that in hindsight to this audience would seem crazy. The first one was we got bankers and regulators and investors and risk managers and journalists and everybody else together in this quaint little town in Switzerland called Basel. And we wrote Basel I. And what Basel I said, after being reviewed by all this constituency, was that a AAA security was cash. It was cash. It was as good as a treasury. It was such a high quality risk that in Basel I, we told the banking community that if you buy a AAA security, you don't have to put any capital against it. There's no capital requirement whatsoever. And the European banks and the US investment banks went crazy. Because if I put an asset on my balance sheet that puts no capital against it, what's my return? It's infinite. And then I get paid on that, and off we go. In hindsight, saying that a AAA security requires no capital and poses no risk looks absolutely foolish. The second one, we did it again, January 1st, 1999. Financial community all got together, governments and banks and investors and everybody. And we said, any sovereign in Europe that issues a sovereign bond in this new currency called the euro, backed by this new central bank called the European Central Bank, is the credit risk of the Eurozone. And from January 1st, 1999 to January 1st, 2009, we let Greece borrow exactly as if they were Germany. And in hindsight, that seems pretty silly. And I think the challenge for us today is there is going to be another financial crisis. And it's going to rest upon an assumption that we all buy into that seems absolutely logical, and then something happens, and what happens in the financial market, it turns, and that accepted assumption turns into a real problem. And so our challenge is to look around the corner and what is that activity that's going on in the financial market that seems to pose no risk until it does.
Yeah, it's really all about the repackaging of risk. I mean, you talked about AAA needed no money against. What was even stranger was taking BBB rated securities and basically creating some sort of strange issuance barbell where you take a BBB, which has some probability of default clearly and certain capital requirements, and let's create a single C rated security, and I'm being simplistic here, and a AAA because on average, that's like a BBB. Well, that doesn't mean that the AAA is completely exposed to risk. There's just a basic logical flaw in that argument, and the metaphor you make is perfect because you have an on-average credit quality in Europe too, and yet it's barbelled with Germany, which clearly, if the mark were a currency, it would be trading at double where the euro is today, and then you've got Greece. The problem with regulation, what we all try to do is we all try to wring all of the risk out of the world as if that's an obtainable goal. But I created years ago something I call Gunlock's law of investment risk, which is the severity of trouble times the frequency of trouble equals a constant. So the more you try to get rid of risk in a short-term sense, which I think is what Basel I was all about, you create a very large severity problem of risk. There's just risk in the world, and you can't regulate it away. And what we do, and risk is a multi-headed hydra. One thing pops up, and we take out the sledgehammer, and we pound on that one. Meanwhile, another head's coming up, and but there's always another head, and the risk is basically constant in the world. So yes, the more you, and this is getting off track, but briefly, the Fed has been trying to create a no-risk financial system with its extraordinary policies, and it's been going on and on and on for years, and there's doomsayers out there who will one day be right, that say this whole thing is going to come crashing down, and they're right to the extent that the longer you try to keep it completely calm, Gunlock's law of investment risk will show up, and you're going to have a big problem down the line. And so that's just systemic to the nature.
It's not off topic though, because it's
and
incentivizing the behavior of the asset management industry.
Yeah, and I think the Fed, with this these programs, including in their mandate basically financial stability, which is a code word for keep risk assets stable or going higher, I think that they're encouraging additional flows into those types of areas because they're perceived to be increasingly safe. I mean, it's hard to believe, but the Fed hasn't raised interest rates in the last interest rate hiking cycle was 11 years ago when it started. Right. So we've got this zero interest rate policy, and all of its ramifications are knit into the marrow of investors' bones. And when it changes, I think that there will be some risks that
pop out. They're just hiding behind the bushes right now.
I guess, I mean, and it's not just the Fed, right? It's the ECB.
Sure,
and
I'm just using it as short.
No, for sure. And so, I mean, I think to both your points, I think an interesting thing is if you say, okay, today, what are we able to explain? What seems perfectly normal today that either we couldn't explain 2 years ago or we won't be able to explain 2 years from now, right? And if you look at negative rates, negative yields, and a number of people paying to put their money to save their money.
I just don't understand why we don't buy negative yielding bonds and leverage them infinitely many times. I mean, if you went to the bank, if you went to, maybe I will. I mean, if you go to a bank and you sign a piece of paper that says, the bank says, I'm going to send you money every single month, and that's just the nature of this contract, and that's all there is to it. Wouldn't you say, can you add several zeros onto that amount? Wouldn't you?
But, you know, Norway's got a problem.
So you've heard the beginning of the systemic risk right here.
Norway's got a problem because it's got 900 billion, and you have to put it somewhere. The idea you couldn't have a negative interest rates, people used to say, oh, well, you can't have negative interest rates because people take their money out and put it under the mattress. You can't stick 900 billion under the mattress.
Right.
China's got 4 trillion, Saudi Arabia's got 1 trillion, and the list goes on, to be honest. There's 10 or 20 trillion in foreign exchange reserves. Negative interest rates on those is a very polite way of charging them for the privilege of saving. It's almost like an addition to US seniorage for the dollar, isn't it? You know,
it's a wealth tax. Negative interest rates are
on the capital reservoirs. I mean, people have mounded up these enormous capital reservoirs, and that just isn't free. You just can't mound up all the capital. That's why there's deficiency of demand, I guess, globally, which is probably why the mega reflationary policies have produced no inflation whatsoever, and in fact a rather sort of healthy, steadily happy growing world we see out there. Funnily enough, it's not what I expected 5 years ago. I was totally wrong, but it does seem to have not worked so badly so far, doesn't it?
Yeah, but kind of like the guy that jumps out of the 20-story building and falls 18 floors and says, so far, so good.
Yeah, possibly.
Well, I was going to offer up an example of just looking around the corner. I don't think it's anywhere near as lethal as CDOs and CDOs of CDOs turned out to be. And by offering this example, I'll probably be offending somebody out there, maybe even somebody up here. But these go-anywhere strategies, I think, are an example of where we're going to wake up a few years from now, and it's going to be, a story that ends in tears.
Unconstrained.
Well, it's all about the pendulum swinging. I mean, 20 years ago in the bond market, the phrase core was coined, and core was essentially a jargon for very tightly constrained strategies. No surprises. The people were reeling from 1994's experience in the bond market. No surprises. And by the way, an index fund approach kind of worked. I mean, the yields were high enough. They met actuarial needs and basic real rates of return. And then when the yields weren't high enough, you had capital gains that helped to support those returns. And that was 20 years ago. And now people want exactly the opposite. You don't want core at all. In fact, what unconstrained means is, please give me as many surprises as possible, and I will naively hope that they will all be positive.
Yeah.
And so it's a code word now. Unconstrained is a synonym for never goes down, conceptually, and we all know that that's not achievable.
No, it's remarkable how we do this sort of time and again, but I think one of the contributions of the asset management business last crisis was we created this product called enhanced cash. And no one stood up and said, that's an oxymoron. You're not going to get both enhanced and cash. And now we have unconstrained, we have liquid alternatives, we all sort of these little interesting acronyms, and you wonder what lurks behind that.
Yeah, well, so you mentioned the CDOs and that kind of thing. In 2005, I was struck by this strange world where you issue a CDO and I issue a CDO, and I buy your equity and you buy my equity. And it just seems like this risk has not gone away, but yet there's no real cash that's funding this stuff. Somehow, I never could figure out how that happened. And there's something about negative interest rates that put me in this through the rabbit hole Alice in Wonderland world. Yeah. One of these days, I mean, you mentioned these big asset pools that can't put it in the mattress. There must be a negative interest rate that's negative enough that it does get people to get out of these reserves? They're not going to put it in the mattress, but
Into
maybe
what,
they,
though,
maybe,
you know,
maybe,
the Chinese
maybe,
can't
maybe
buy.
they buy Bermuda.
The Chinese could buy the US equity market with theirs, but they wouldn't be allowed
what's his name
to.
bought
They're not
Lanai?
allowed to buy anything. They're only allowed to buy 1% of every company in the world. So that just doesn't put enough money to work. There's nothing they can put their money into. There's nothing, you know, the biggest capital pool in the world is treasury bonds. You have to put your money in treasury bonds if you're a big sovereign that's got billions. And that's all, it's all actually good news because that's all part of creating international currency convertibility. That's why we're now having capital flows, which is what this panel's about, around the whole world. It's because the developing countries have now got foreign exchange reserves so that they can run floating currencies and we can have, free trade and financial prosperity for all in the world.
So that's just another version of the risk gets pushed somewhere else, right? You can't hide it, right? You have, it shows up in foreign exchange. But, I think the, you're right, there has to be a point of negative rates where people say, I'd rather have the chance of losing that much.
What
right?
negative
And
rate would you leave this panel and go out and buy stuff this afternoon? I mean, it's got to be a number. Negative 99, I'm sure you would.
Definitely negative 99.
Okay, negative 50.
You're not saying that's a tax rate, though, right? I mean, there's, that's good. It's a good point. I don't know what it is, but it's going to be different for different investors.
Sure it is.
Another thing and it's kind of a little bit combined with the negative rates where, there's got to be capital searching for a place to go, but there's this tendency for people to take pension surplus risk and and if they think that they're in surplus, to damp it down. And so tremendous, if you think about asset management trends, one of the demands is for longer dated, risk-free type, treasury type yielding assets.
Strangely, at the all-time lowest interest rates in history.
Exactly, and so probably not unrelated. As you think about the influence of incentives and of the asset owners or the asset managers and the effect on capital markets, the appetite to buy more and more long-dated treasuries is almost it's almost endless.
But Eric, maybe just shift a little bit to a positive note. One of the things at Blue Mountain that we've spent a tremendous amount of time on, and if you're thinking about stress testing the capital markets or the financial system, one of the things you might have done is, what would happen if the price of energy fell over a 2-month period by 50%? You've got,
that's not going to happen.
It has exploded as a percentage of the high yield market. Everything is covenant light, so no one's got any covenants to trigger. The E&P investment in the United States has been enormous. If you have that sort of shock to the system, the capital markets are going to tie up. In fact, I think what has happened is, from private equity to hedge funds to long-only managers to pension funds, have poured an enormous amount of time into understanding the dynamic of what's going on in the energy space. And in fact, the sort of efficient use of capital, both long and short, to reprice assets in energy has been unbelievably quick. And I think, stepping back from it, pretty orderly, but given tremendous investment opportunities for people like us, where we can go anywhere in the capital structure, we can go long or short, and play this temporary dislocation and generate returns for our investors. So I think how the capital markets actually reacted to what's gone on in energy is a pretty positive thing.
Does that not suggest, though, that maybe the sort of great bond market liquidity crisis, if you will, or calamity that people are predicting, as you point out, David, in many quarters, may not prove to be such a consequential event after all, that there is
As long as interest rates are low, I think that's right. I mean, one of the reasons why that happened is everyone is starving for great ideas, particularly income-related ideas, and as long as you have zero interest rate policy, that's going to be the case. So the real linchpin of all this is zero interest rate policy. What happens when all of the consensus ends up being right and the 10-year treasury actually does go to 6 or 8? Do you think there's going to be all this enthusiasm for 5.5% yielding junk bonds? I don't.
Well, hopefully they're at 13 then. Yeah, I'll offer something I think is also optimistic, more from the point of view of the active managers and from Alpha, which is, you can play it both ways, I suppose, but there's been a tremendous move toward indexation, which is in itself a positive development, right? So to your point on betas, Jeff, there's a large amount of assets which should be invested in beta. But of course, what that does, as assets go into the index world, it takes out people who are kind of coming in every day and trying to fix trying to find the imperfections in the pricing that's inherent in the indices. And that actually creates, some people think that indexing and ETFs create less opportunity for alpha. In fact, because there's so many more dollars who are not paying attention to that, to where the sources of alpha are, it actually should create more opportunities for alpha. And so, as we get through this kind of, risk on, risk off, kind of very directional kind of healing of the markets, you get into a place where there are actually many investors, many asset owners have kind of abandoned the search for alpha, which in some sense leaves the field open for experts to do it, who are well situated to do it on a day-to-day basis.
Before we have to wrap up, I want to do a little crystal ball gazing, because we're talking about reshaping the global financial system. John, again, you're in the business of being pitched. How do you think, what do you see right now with the proposals, ideas that float across your desk, or that you hear in the course of talking to or meeting with asset managers, is sort of around the corner, the next phase, the next thing they're going to offer you, the next thing they're going to do, as a consequence of everything that we've been discussing, whether it's regulation of the banking industry, whether it's the accumulation of assets? I'm just throwing it out there.
Boy, a lot of pressure. Two things. First, it just strikes me that there's tremendous overcapacity in our industry, that it's been supported by zero interest rate policy and the Fed and other central banks inflating financial assets. And so what strikes me, just in a palpable sense, we have an open door policy, so we see everybody, is it just seems like the overcapacity in asset management is acute. And so I don't know how that ends, but I don't think that ends well. And then the second thing is this notion that I mentioned earlier, the go anywhere, the unconstrained is the pitch du jour, and I think that ends badly too, because there are asset owners that are going to buy that and they're going to present it to their boards as fixed income, and it's going to show up in that part of the pie chart as fixed income, and everybody's going to assume that it's capital preservation, but under the hood it's all risk seeking, and I don't think that ends well.
Since a lot of unconstrained has negative duration, it's actually anti-fixed income.
Yeah. Yep.
Folks, on that note, I would like you to join me in thanking our panelists here for Follow the Flow: Kent Clark, Jeff Gundlach, David Harding, John Sheridan, and of course Jess Staley on the front. Thank you for joining us.